Hello, everyone. I'm your host, Cam Webster, and welcome to The Art of Boring, the podcast where we dive deeper into Mawer's investment philosophy and thinking in order to help you, our listeners, become more informed investors. Ultimately, we hope to connect you with the people at Mawer who find excitement in delivering on Be Boring, Make Money.
This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based upon the information available at the time and are subject to change.
We're here with Christian Deckart, co-manager of the Global Equity Fund, and we're here to talk global equities before we talk specifics in terms of what's in the portfolio. Nice small question for you, Christian. First of all, welcome.
Thanks, Kim.
Or welcome back.
Thank you.
Always a pleasure to have you on. So today, yes, global equities, lots going on in the world, particularly related to trade or central banks. So let's start there. Let's start with the risk picture. What are you seeing from a risk perspective?
Yeah, from a risk perspective, we take that into account in our stock picking process, obviously, on the company specific side. So we rank all businesses we invest in, the quality of its business model, the quality of management, and the quality of risks. So risks are a central part. Often we're wondering, are risks higher right now, or is it just our perception of risk? And the example I have in my head as a father of two small children is, well, how risky is it that your children fall down the stairs? If they've never done it before, you may not be worried about that. But if they've fallen off just recently, then all of a sudden you see this risk and you're more concerned about it. So the question we often have in our minds is, are risks really elevated, or is it perception of risk? Because often in the media, when you hear about risks, what people really try to say is not risks are higher. They just say our own perception of risks is higher right now. So I would definitely say that perception of risk seems higher these days. I'm not sure the risks are really higher, right? The risk of a trade war probably has been there since the US got the new president, but now that risk is playing out. So the perception of risk is higher now than it was maybe a year or 2 years ago. But you could argue that the absolute risk actually hasn't changed. Like the risk of your kid falling down the stairs hasn't gone up after it's fallen down the first time. It's always been there. You just didn't know. The other thing I'd like to point out about just risk is that news travels very fast these days. So if you have an event in India, China, wherever in the world, we in Calgary are very much aware of it. While if you rewind the clock 20 years, 50 years, or 100 years, we wouldn't get all these bad news that is on the world. So it's partly due to media that we are aware of all the risks that happen out there. So that again falls in that under that theme that I just talked about, risk versus perception of risk. And I just want to point out that, yeah, when you open the newspaper, you're going to read bad news from all over the world, bad economic news, bad political news from all over the world, which probably you wouldn't have done to that extent 20, 50 or 100 years ago.
Let's advance the argument or the discussion a little bit and say, well, what risks matter? So in our world, as we manage these global portfolios, what risks matter? Because a lot of it's noise is what I'm hearing.
Yeah. So on a company-specific basis, as you may know, Cam, we rank stocks on what we call the matrix. So on two axes, one is quality and the other one is return potential. And what we're aiming for is to buy the best businesses, best defined as highest quality of management, highest quality of business model, and lowest risks. And we're greedy, so we try to do that also at the best possible return potential. So best companies at best return potential. Now, capital markets aren't totally efficient, but they're not totally inefficient either, i.e. it's very difficult to buy best companies at the best valuation. So we have to find a balance between the two. But where do risks come into play? Well, in both axes, on the quality axis in terms of risks directly. So everything that could affect a company, whether it's risk that they get sued, that a patent lapses, that a competitor comes up, all these things go into that. And risks come in on the return axis where, if a company gets a hit to sales or has additional cost, then that impairs the return potential.
Okay, so we have rankings for both those parameters.
Yeah.
What do we do with them?
Well, we compare them, the companies that we have looked at, that we have researched, and compare them and try to find the best trade-off between that best quality and the best price. And the better that trade-off is, the less we have to compromise on any one of the two or on both criteria axes, the higher we will weight it in our portfolios.
So a really high quality with a high potential return would get the highest.
Would get a higher weight
in the portfolio.
That said,
Okay.
we have a self-imposed limit of 6% per security. We will not put more than 6% of clients' capital at risk in a single position because the future is always uncertain. We could be wrong. But yeah, towards that 6%, that is the mechanism.
Off of discussion of that tool, the portfolio construction tool, Christian, it looks like to me, recent activity suggests you've been going a little more defensive. So there's a few names that even a Canadian name in the global equity portfolio, TELUS. So we've got a few names that to me look defensive. TELUS, Pepsi, something called Bunzl.
Bunzl, that's a name that probably Canadians are less familiar with. It's a UK-listed company. They provide consumables, mainly to retail businesses. So if you think of your local coffee shop where you go and then you get your coffee mug there, you get your lid, however you call that, what protects your hand against the heat.
The sleeve.
All these things are disposables that are not really the core business of the coffee shop, but they need it to keep the business running. And Bunzl is a distributor of these disposables. So it's very much a be boring, make money business. It takes away complexity from my example was a coffee shop chain. So it takes away complexity from their business. Bunzl takes that over. And it's a nice repeat business. And as you can see from my coffee shop example, we think that it has a good chance of being less economically sensitive than, say, CapEx goods. Because, in a recession, people, maybe they trade down in their coffee, but they will still have coffee in some shape or form.
Thanks for the profile of Bunzl. What I am curious about now, Christian, is based on some of the moves in the portfolio, is this a signal that you're getting more defensive or not? Yeah,
I'd say, we're taking these decisions company by company on the matrix, as I described earlier. The goal we're aspiring to is to buy the best businesses at the best valuation. And so, we look at it company by company. And the defensiveness might be more a result of that analytical process. So it might be that the market after a 10-year bull market is not very much concerned about risks. I can't prove that, right? That's a suspicion I have. And so companies that are more defensive might, all else equal, be offered at more attractive valuations, maybe. Again, that's nothing I can prove. I can just say on the matrix, when we rank these stocks that are relatively defensive, have a relatively good valuation in our opinion, then they are in spots where, we think they're a good value. So I would say we're not doing that from a top-down approach to say we're going into defensive stocks now. But if we follow a stock picking approach, I realize that, it seems we're more drawn to defensive names in the current period. That said, I told you it's a stock-by-stock process. But of course, we also have the portfolio in mind as a whole. How will these stocks interact? And so after that 10-year bull market, we don't mind actually if the stock-by-stock process leads us to a more shift towards the defensive names, which I agree with you, it seems to do right now.
Just to summarize, it's not necessarily a conscious decision. It's the use of the tool that informs the decision-making process, and the output is what I'm seeing as defensiveness.
Yeah, and it might be through a feedback process in the market that the market right now just doesn't value these defensive characteristics. And so that's why we feel we get good quality businesses at good valuations that happen to be in defensives.
The defensiveness aspect isn't just coming from something you see.
No, because as I said earlier, it's the result. But on the other hand, also, we don't think, when there is a storm, that's not the right time to fix your boat. So we think the right time to fix your boat, to have a balanced, defensive, be boring, make money portfolio is when markets are calm. So the saying here we have is we don't fix our boat in a storm.
Your mention of a boat is a good opportunity to shift gears to how do you deal with underperforming stocks in the portfolio? We have a portfolio, some go up, some go down. So let's talk about some of the holdings that have gone down recently and what explains it. How do you react to it? How are you using the matrix with it? All that good stuff.
So matrix applies to all our portfolio management when we buy a new company, but also while we own the company. So what happens when a stock is down? If a stock is down without fundamental news, well, then it will have moved on the return axis. It will have become better future return potential because the stock is down already. And so it becomes relatively more attractive. So you would expect us to increase the position. But often stocks are down because something fundamental has changed. And so then it becomes trickier because then you have to compare, well, how much has it deteriorated? How much has the valuation become cheaper? And you have to make that trade-off again. And there's really no cookie cutter answer that we look at each situation stock by stock, often then do more research to process the new information, really.
So specifically, I would highlight Tsuruha and Seven & I. So both Japanese drugstore retailers, pharmacies, basically the Shoppers Drug Mart of Japan. One went down 40% in the year. So explain that, Christian, please.
Yeah, so in what we see and what we see fundamentally there, and what is also spooking the market is labor shortage in Japan. So, you know that the country has a declining population, aging population, and so they have shortage in skilled labor. And so you do see cost inflation in people that sell in a convenience store or in a pharmacy. Pharmacists are becoming more expensive. And now this is the great thing about global investing. There's always a new challenge, because the mental model we would apply in the West is that, well, if labor cost inflation hits convenience stores or pharmacies, all competitors are going to be hit by that equally. All workers will want higher salaries. So the result will be that labor cost is going to go up, and the convenience stores and pharmacies are going to increase prices towards the consumers. And in the end, it's the consumers that take the cost of that increased labor. That is what strategic logic would suggest. By the way, Strategic Logic is a great book on the fundamentals of why companies are profitable. And so Strategic Logic would suggest that, this gets all passed on to the consumer. And we see that work out like this in Western countries very often in many companies we've invested in. However, Japan is a bit different, and that's what makes global investing intellectually so stimulating, because you can't rely on all the mental models you've used in other parts of the world. And in Japan, it seems effectively that the convenience stores and the pharmacies are taking the hit from that cost increase, which goes against all logic, but that seems to be how it is there.
Next question begs, what do you do with that position? So it's down. Yes, there's a fundamental change, but maybe your valuation changes. So how do you deal with the position size? How do you deal with it?
Exactly. So our current assessment of future cash flows is lower than it was a year ago. And at the same time, the stock price is down. So overall, there's not much reason to change a lot in the position. It would have been great if we could have anticipated that move in the stock market, because if we had some proprietary information on that labor cost inflation in Japan and that they wouldn't pass it on, but we didn't. We just didn't in this case. So here we're actually taking into account how the stock has performed and what we think of future cash flows. Probably the weight we have right now is a reasonable weight.
Let's look forward a little bit now and say, well, okay, the world is always changing. So what are you doing now, Christian, to create opportunity for the portfolio?
Yeah, so we quite like phases with market volatility like now, because it allows us to look at new businesses we haven't looked at before, where prices are maybe down 20, 30, 40%. It is a difficult situation once that happens to companies that are in the portfolio, because then you might get tricked into doubling down, into falling into the psychological trap of trying to validate your previous findings and just buying more, although maybe the information has changed. But we do like situations where things fall that we don't own already, because, given that we don't own it, we think we have a clearer judgment on things. So we can go out, talk to these companies, do our research. And so right now the team is pretty busy looking at new ideas, new businesses to invest in. And the saying is, you get rich in a bear market, you just don't realize it at the time. It's really in times like this, in volatile times, where we, if you will, where we produce future performance, because it's in times like this that we can buy wealth creating business with excellent management teams at a discount to intrinsic value. So in other words, we'll reap the benefit of today's work over the next few years. And we don't know when exactly, but an environment like this is a good ingredient for us to find good businesses at reasonable prices.
All right. There you have it. The words from the chef. We have good ingredients in global equity. Thank you for joining us, Christian. We'll have you on for sure sometime soon.
Thank you.
Hey, everyone. Cam here again. To subscribe to the Art of Boring podcast, go to Mawer, that's Mawer.com/podcast. If you enjoyed this episode, leave a review on iTunes, which will help more people discover the Be Boring, Make Money philosophy. Again, thanks for listening.